Hello and welcome to another episode of Federal Church Presents Better Than Bloomberg. Continuing our 2023 coverage of the global financial system collapse, the worst ever. So I came across somebody who was trying to tell me that, things are going to be wonderful in Canada because we only have 5 banks there. Which brings up the better point of what the other person was asking, which was, well, where are they going to put all their deposits while these banks fail? And it brought up this question of bank concentration and crises. And I came across this old National Bureau of Economic retards, because if they were actually of any use, they would probably be making much more money than working for the National Bureau of Economic Research, which is usually professors who contribute to this whatever working paper crap, like these 3 clowns. But these have to be the dipshits of the century here, and that's what I'm actually going to entitle this video: Dipshits of the Century. And yeah, whatever. I don't know if that's his real name, or they just make this shit up, but there's Beck, Cunt, and Levine, Money Changer. And this is actually from August of 2003. So 20 years ago. You can see how wrong these shit fucks were. We're not going to go through the entire paper. You can download it. It's called Bank Concentration and Crises by, these 3. Alright, so back to the paper now. Click out of there. But yeah, I'm not going to go through the entire paper, but let's go to the abstract here, these fucking geniuses. Motivated by public policy, and again, you can see how this failed too before we even go through this. You can see how this shit failed, like the concentrations with the large investment banks. Namely one like Lehman. Lehman kept acquiring stuff, kept acquiring more garbage. It became more concentrated between a few banks, and then the mortgage-backed securities imploded. Another good example was, what you have going on now. What J.P. Morgan was. It was J.P. Morgan Chase. Before that, I think it was Chemical Bank and Bank One, whatever it acquired. It acquired a bunch of banks. Now it became this huge, behemoth. And now they get to screw the taxpayer out of billions of dollars. Like with whatever garbage that they bought. Was it the whatever garbage bag that they bought? They took all the nice assets, or whatever is good, left in this garbage, basically commercial bank, and then left the taxpayer to be screwed by, for billions of dollars. And again, supposedly that's okay because they're safe as a big bank, but that's not true either when they have their derivatives implode, and usually those are the big banks that only deal in that sort of thing. But abstract. Motivated by public policy debates about bank consolidation, you're a fucking genius, and conflicting theoretical predictions, where you can actually see how they're both. You see all these shit small regional banks blow up because of the dipshit problem, and then you get to see how fucking terrible that will be for the countries that only have a few big banks, and when they go under, when they get, basically bitten in the ass by the dipshit problem. Well, yeah, where they're going to put their money, like the person so wisely asked there. About the relationship between the market structure of the banking industry and bank fragility. Oh, and don't forget where this gets awesome too, is with the counterparty risk with the derivatives implosions. So now you only have a few banks that have probably trillions in notional in derivatives. Yeah, you're pretty fucked. So bank regulations and national institutions on the likelihood of suffering a systemic banking crisis. And again, you already would have seen this too with Credit Suisse, because there's only a few major banks over in Switzerland, which was actually more than the GDP of Switzerland itself. So, using data on 70 countries, again, these fucks in their data, but from 1980 to 1997, they actually think they were empirical quantitative, even though they couldn't fucking read and do them. We find that crises are less likely in economies with more concentrated banking systems. And they were fucking wrong there in 2008, and they're going to be wrong both ways in 2023. Even with a ton of shit little banks like in the U.S. and more concentrated banks in countries like Canada, and well, there's a lot of them. Fewer regulatory restrictions on bank competition and activities, and we also saw how Glass-Steagall fucked up everything too in 2008, especially. And national institutions that encourage competition. And I think it's just great. This fuck's name is cunt too, by the way. Dumb fuck. Let's see here. So, introduction. The consolidation of banks, and again, where are these guys from? Oh, they're all from the fucking World Bank. And then some shit clown from the University of Minnesota. But the consolidation of banks around the globe is fueling an active public policy debate. And again, you would have also seen a lot of this stuff prior to 2008. It's just like that one book I was reading, the one about, the one from the guys at Lehman. And then how all the public policy stuff prior to that was what pretty much culminated in the real estate and mortgage-backed security collapse. Especially the people who were actively doing, what was the one he described? It was, sorry, he's retards medicating my food, or telling people to medicate my food, where the legislators would even pull some sort of shenanigans, the regulators, pulling some sort of shenanigans, like if banks didn't actively lend to people who were definitely not qualified to be lending, under the guise of whatever crap it was, like equality or fairness or whatever, where, well, they're not creditworthy. This really isn't a question of it. But that sort of thing. And that was definitely, the government meddling in things that they should not have been. And then that ultimately led to, well, mortgage collapse. Or real estate collapse as well, mortgage-backed securities and real estate collapse. On the impact of consolidation on financial stability. I can say this about that. Indeed, economic theory, again, their theories are fucking useless. Especially if you subscribe to the Austrian school, a lot of these clowns and Keynesian ones, know nothing, and Keynes was broke himself. Provides conflicting predictions about the relationship between the market structure of the banking industry and banking system fragility, which you get to see now, especially as banks collapse. And they've already collapsed in more value than in 2008. Motivated by public policy debates and ambiguous theoretical predictions, this paper investigates empirically, supposedly, the impact of bank concentration on banking system stability. Some theoretical arguments and country comparisons suggest that a less concentrated banking sector with many small banks is more prone to financial crises than a concentrated banking sector with a few large banks. Again, we can see how fucking wrong they were 20 years ago. First, proponents of the concentration stability view hold that large banks can diversify better, but they don't. So, this is just fucking academic bullshit, because, it's kind of like Charlie Munger fucking says, you don't fucking make money diversifying. You make your money concentrating on your trades there. So that banking systems characterized by a few large banks will be less fragile than banking systems with many small banks. Well, look at those shit fucking banks implode now. It's already more than 2008. Second, and then the concentrated banking systems, kind of like in 2008. Were horrible. Yeah, it imploded. So the point being, they can come up with any sort of theoretical, what is it, ivory tower academic bullshit. Point is, when you do stupid shit like the dipshit trade, which wasn't necessarily motivated by greed, but by, failure in interest rate policy, especially the negative interest rate policy, well, then you have these people who are in these banks trying to make some money, and then taking on risks and participating in activities that they should not be doing. There was another write-up from Zero Hedge about that. It's a pretty good one. I'll get to in another video. So, second, concentrated banking systems may enhance profits and therefore lower bank fragility. We saw that definitely did not happen when they were making money hand over fucking fist in 2008 in mortgage-backed securities until it all imploded. High profits provide a buffer against adverse shocks. It didn't in 2008. Not for Lehman. Not for Bear Stearns. And increase the franchise value of the bank, reducing incentives for bank owners to take excessive risk. And again, I don't know what planet these fucking academics live on. But the people in those banks are going to take as much fucking risk as, you know, their bonus or their risk management people let them, and as they seek out their bonuses. And the best part is that it's, you know, from Stiglitz too, which, you know, it's another fucking clown. Third, some hold that and this is just hilarity too. So you think the people at fucking Goldman aren't going to be taking shitloads of fucking, or even better, what was it? Lehman was one of the biggest banks at the time too. Bear Stearns was not small itself. And yeah, that definitely was not the fucking case. Third, some hold that a few large banks are easier to monitor than many small banks. Well, how did that work out? So the corporate control of banks, and you know, my example is the 5 banks in Canada. You fucking put your buddy. They were all in the dipshit trade too. They were being monitored. Shit, there's only 5 of them. And nobody said to themselves, interest rates are going up. You know, especially as the Canadian Central Bank is the one raising rates. It provides them with their rate trajectory. Nobody said to themselves, rates keep going up, and when rates go up, our bond values go down. And if all our banks have shitloads of these garbage toiletries, especially, not to mention all the other sovereign debt or whatnot, we're also raising rates in lockstep. Nobody said to themselves, you know, we're only looking at these 5 banks, and then somehow this might be a bad thing for these 5 banks. Possibly. So that, again, they're not. That you can't assume that these people will do anything completely rational, which is probably what these economists make, assumptions that these economists make. Not to mention, you know, that they would only take so much risk versus, you know, try to line their fucking pockets. So that corporate control of banks will be more effective and the risks of contagion are less pronounced in a concentrated banking system. See, this is the thing. I don't know if they know the definition of that word. You have contagion, which not only spreads to your banking system, but spreads to all the other banks on Earth that it deals with. Like this stuff with the small regional banks now. Yeah, they try to paper over it. They got some shenanigans. Supposedly the Treasury is going to backstop 17 trillion with the T of fucking deposits, even though that's 3/4 of the U.S. GDP. And as of right now, the Treasury has less than $20 billion in their coffers, and is still begging Congress for more money just to run the country alone. So what I'm saying here is that it's probably not going to fucking happen. And even if it did, the dollar in which it's denominated, that these dipshits will soon find out, will be worth nothing. Again, don't forget, they only printed about, $1 trillion since COVID. And look at the mess that made. When you have another $20 trillion printed, probably going to be pretty fucking bad. So, yeah, I don't think they think anything through. But, back to the original point, where you're not really going to be bailing them out either. Because it's going to spread. Oh, and as I was saying, you know, right now you just had a few small banks fail. And it's already more of a failure than Lehman, or Bear Stearns and all the other banks in 2008. That's just the beginning. There's thousands of banks more to fail. And then when those banks fail, and the derivatives on all the other stuff to implode between the bigger banks, that's when you see contagion. And then contagion isn't only to the banks, for example, in the United States. It will be spreading to all the other banks that they deal with, namely like Japan, Europe, whatever else. That's when they figure out what contagion is. So, saying that the risk of contagion will be less pronounced in a concentrated banking system, I think they're foolishly, having some sort of tunnel vision there, thinking that it's only going to be within the one country that those banks belong to. When it's, the whole point of the contagion is that it spreads systemically throughout the entire global financial system. Kind of like in 2008. What you're seeing now. According to Allen and Gale 2000, the U.S., with its large number of small banks, supports this concentration stability view since it had a history of much greater financial instability than the UK or Canada, where the banking sector is dominated by few larger banks. And again, this is 2003 before 2008. And just like I said, I would know damn well about this because it fucked up my job over at fucking RBS or whatever NAT was, whatever they call it in the UK. And again, this was the biggest bank on earth. RBS at the time was the biggest bank on earth and by balance sheet. And guess what? It went under and it had to be bailed out by the UK. So you can already see where that part is, that part of their little theory fails. An opposing view is that a more concentrated banking structure enhances bank fragility. Well, you saw that with Lehman and Bear Stearns. First advocates of the concentration fragility view note that large banks frequently receive subsidies to implicit too big. Yeah, and they did. And then now you got that example like I gave you at JP Morgan Chase, where it's now taking shitloads of taxpayer money by, being able to take up these banks that failed and essentially dump off the billions of toxic assets on the U.S. taxpayer while taking anything that might be worth anything for their own books. This greater subsidy for large banks may in turn intensify risk-taking incentives, increasing the fragility of concentrated banking systems. Oh, even better, Michigan's in this one. This is, Michigan is the one who wrote the money in banking stuff that I was referring to. It's a textbook a lot of college people use. And that was the one I was referring to. Where, did these dipshits read this fucking book? It's easy to read too, by the way. It's very easy to read. These shit fucks like SVB who couldn't figure out, well, if you have all your reserves in toiletries and interest rates are going up, it's going to be very bad for your fucking bank. Second proponents of the concentration fragility view would disagree with the proposition that a few large banks are easier to monitor than many small banks. And I'm not even going to bother reading this, but you get to see where both ends of these shit theories are wrong, where these fucking clown academics fail. First off, they make the assumption that people will act rationally or, let's say, honestly. Generally, when people go into fucking, investment banking or trading or that sort of thing, they're there to make as much fucking money as possible. They're not really there for, saving the fucking world. So that's where their first assumption fails. And then the second assumption they make is that these people are either rational or competent. And as you saw with those dipshit commercial bankers, who only end up there because they're dipshits, they weren't qualified to do the other more well-paying stuff, you see that they managed to make the dipshit trade and destroy the entire fucking banking system, without exaggeration. And the only thing holding it together is an accounting shenanigan that, they're still begging Congress to paper over. 17 trillion fucking dollars. So, point being, it's a failure. And this, whatever these clowns come up with in their little working papers, dipshits of the century. This is from August 2003, and you see how it's just a complete waste of time to read. I'm not even going to bother reading this here, but it is a failure. the answer to that original question of, okay, so if we only have 5 banks and they all fail, you're not going to paper over this one. Where do you put your money? Where do you put all those deposits? And well, the answer is, it will be systemic. And all the other banks in the other parts of the world will be affected. So, you pretty much have 2 choices. You have bullion, and then you have the blockchain. And that's pretty much the answer to that question.